Imagine spending $1,000 on Atlanta Braves stock. You become part financial backer, part fan, with your heart and wallet riding on every pitch and championship run. But here's what remains hidden behind that stock certificate you proudly display. While most sports franchises operate behind closed doors of private ownership, the Braves stand exposed in the harsh spotlight of public markets. This transparency creates a fascinating tension. Does answering to shareholders help or hinder the team on the field? Today we're stepping into this collision between Wall Street and the baseball diamond to uncover the real question: who actually controls America's team and at what cost? What if I told you that for less than the price of a premium game ticket, you could own a piece of a Major League Baseball team? This isn't fantasy, it's the reality for the Atlanta Braves. With shares trading around $40, practically anyone can become a partial owner of one of baseball's most storied franchises. But how exactly did America's team end up on the stock exchange? The answer involves a media mogul, a cable company, and a series of corporate maneuvers that transformed the Braves into a financial anomaly in American sports. The story begins in 1976, when Ted Turner, the visionary maverick behind CNN, purchased the struggling Atlanta Braves for $10 million. Turner, a baseball fanatic to his core, occasionally suited up as manager and transformed the team into the centerpiece of his growing media empire. The Braves became the flagship programming for his superstation WTBS, broadcasting games nationwide and cementing their America's Team nickname. By 1996, Turner Broadcasting merged with Time Warner, and the Braves became one small asset within a corporate behemoth. This corporate shuffle continued in 2007, when Liberty Media, led by billionaire John Malone, acquired the Braves in a tax-advantaged exchange with Time Warner. Liberty wanted Time Warner's stake in another company and took the Braves as part of the deal. Baseball was merely a convenient bargaining chip. The critical turning point came in 2016 when Liberty Media restructured. Like splitting a conglomerate into specialized divisions, they created 3 tracking stocks, including Liberty Braves Group, which specifically tracked the economic performance of the Atlanta Braves and their real estate development. This corporate maneuver opened the door for everyday fans to invest directly in the team's financial performance. The transformation completed in 2023 when Liberty Media executed a full spin-off, establishing the Braves as an independent, publicly traded company. This unprecedented move meant quarterly earnings reports, SEC filings, and complete transparency into baseball operations. The financial curtain had been lifted. This disclosure contrasts sharply with teams like the Green Bay Packers. While called publicly owned, Packers stock offers no dividends, can't be resold for profit, and provides little beyond bragging rights and shareholder meeting invitations, essentially commemorative certificates rather than investments. The Braves' public filings reveal that approximately 90% of revenue comes from baseball operations, while 10% flows from the Battery Atlanta, the development surrounding Truist Park. These numbers fluctuate seasonally, with home games driving significant revenue spikes. For fans, this creates a dual identity as both supporters and potential shareholders. After a successful homestand, they can calculate the team's earnings. When a star player signs a massive contract, they can evaluate the financial implications. What makes this situation particularly ironic is that the Braves' public status wasn't a strategic baseball decision, but the result of corporate financial engineering in boardrooms far removed from the diamond. This accidental public company now navigates a unique tension, simultaneously satisfying Wall Street demands for quarterly returns and fans' hunger for championships. Those questions about balancing profits and championships highlight exactly why the Braves stand virtually alone in American sports. The financial transparency that comes with public status is precisely what terrifies most billionaire team owners. But why? Behind the closed doors of private ownership lies a treasure trove of tax advantages. According to ProPublica's investigations, billionaire sports team owners regularly report massive financial losses on their tax returns, even as their franchises skyrocket in value. These paper losses offset income from other business ventures, dramatically reducing their overall tax burden while their personal wealth continues to climb. This financial strategy remains unavailable to publicly traded companies answerable to shareholders and the SEC. Private ownership resembles a high-stakes poker game where players can hide their cards from the table. Jerry Jones would never offer Cowboys stock to the public because secrecy provides competitive advantages beyond tax benefits. Private teams possess something more valuable than money: freedom. Without quarterly earnings reports or shareholder votes, privately owned franchises make decisions that might look terrible on a balance sheet but brilliant on the field. Spending $50 million on an unproven international prospect or investing heavily in analytics with distant returns becomes impossible to justify to profit-hungry shareholders demanding immediate results. League rules themselves create roadblocks to public ownership. MLB has historically restricted corporate ownership structures, with Rogers Communications' Toronto Blue Jays standing as a rare exception. These regulations maintain the private club atmosphere defining professional sports for generations. Private ownership shields teams during contentious stadium negotiations. Teams approach cities for taxpayer funding while keeping actual finances hidden. A privately owned franchise can claim financial distress to local governments while simultaneously boasting about record revenues to potential minority investors, a contradiction impossible under SEC disclosure requirements. The Boston Celtics public experiment, 1986 to 2002, serves as a cautionary tale. The team found itself torn between basketball decisions and shareholder demands, missing the playoffs 7 times between 1992 and 2002. Star players were traded or allowed to leave when their contracts threatened dividend payments, ultimately damaging both performance and brand value. While avoiding public markets, sports franchises haven't completely closed investment doors. The NFL recently allowed private equity firms to purchase minority stakes, 10 to 30%, in franchises. This provides capital for stadium renovations or technology investments without surrendering control or financial privacy. The American Investment Council noted, this gives owners more options for investing in the franchise and enhancing team value. Without public market scrutiny, these arrangements offer fresh capital without quarterly earnings calls or disclosure requirements, maintaining the league's ownership structure while adapting to skyrocketing team valuations. Unlike their secretive counterparts across the league, the Braves perform a high-wire balancing act between box scores and balance sheets. When their 2021 World Series victory sent stock prices soaring 12% overnight, it created a fascinating question. Can a team truly maximize both championship potential and shareholder value simultaneously? Or must one eventually be sacrificed for the other? The numbers reveal an interesting story. Since the spinoff from Liberty Media, the Braves stock hasn't kept pace with the broader market. This underperformance raises serious questions about the team's ability to satisfy Wall Street while still fielding a competitive team. Every decision, from trading for a closer at the deadline to extending a homegrown superstar, gets reflected in both the standings and quarterly earnings reports. This creates a distinct pressure cooker for the front office. While privately owned teams like the Dodgers or Yankees answer only to their billionaire owners when exceeding luxury tax thresholds, Braves management must justify these expenses to thousands of shareholders who may prioritize dividend payments over divisional pennants. The Braves operate in a glass house where financial moves face intense scrutiny. Private teams can hide behind vague statements about investing in the future, but the Braves must disclose detailed financials including player salaries and concession revenues. Fans can track exactly how profitable each homestand was, something unheard of in professional sports ownership. Picture this scenario. A star player's agent sits across from Braves executives during contract negotiations. In one ear, baseball operations whispers about championship windows. In the other, financial officers remind them of the upcoming shareholder meeting where they'll need to explain why a $300 million contract is worth the investment despite reduced quarterly returns. This confrontation happens regularly in the Braves front office. The Battery Atlanta development represents their shrewd response to this dilemma. By creating revenue streams beyond baseball operations, luxury apartments generating consistent rent, restaurants buzzing even during the off-season, and entertainment venues hosting year-round events, the Braves have built financial stability that persists regardless of on-field performance. This mixed business model positions the Braves uniquely among sports franchises. They tell shareholders a compelling story about long-term growth through real estate while celebrating victories on the field. Yet the fundamental tension remains. Inside the organization, these competing priorities create fascinating dynamics. Baseball operations executives push for championship resources, while financial executives monitor quarterly reports. This tug-of-war shapes everything from draft strategies to trade deadline decisions. The evidence on public ownership's impact presents a complicated picture. Their 2021 World Series championship proves they can reach baseball's pinnacle while answering to shareholders. However, their spending patterns show more financial restraint than many privately owned teams with similar valuations. They've developed homegrown stars and made strategic acquisitions while maintaining financial discipline. A balancing act that's impressive but constantly under pressure. So what does the future hold for sports team ownership? Private equity is making major moves, with firms now allowed to buy minority stakes in professional teams across leagues. The NFL's policy shift permits institutional investors, providing capital for stadium renovations and technological upgrades. Leagues remain cautious about full public ownership, concerned with financial disclosures and labor negotiations. Sports business experts continue exploring alternative capital raising methods. The fundamental question lingers: can the passion of championship pursuit coexist with shareholder returns? Like a game with constantly evolving rules, the future of sports ownership will be defined by this delicate balance, reshaping the experience for both fans and investors alike.